Welcome champions. I hope you all are doing really very good. So today we are going to study how financial sector and financial market work together to channelize the funds. First of all, let's study two terms. First is lender savers. Term is borrower spenders. So who are lender savers? People who have extra saving are called lender savers. Suppose here is a Mr. A and one person is Mr. B. Two persons are here. Since Mr. A and B, their income is A earns 1 lakh per month and B earns 30,000 per month. Suppose Mr. A saves 70,000 per month. On the other hand, Mr. B saves 10,000 per month. Now, Mr. A is saving 70,000 per month, so he has excess saving. Now, Mr. B needs to buy something that cost him 20,000. That is, he saves only 10,000, but the thing he want to buy costs 20,000. What he'll do? He has to borrow 10,000. Now, if Mr. A is ready to lend, that is, he is ready to lend his savings, then Mr. B can borrow and can spend it. From here, it should be clear to you that the person who is extra savings, that is savers who lend the money, are known as lender savers. On the other hand, the person who borrows to spend are known as borrower spenders. So I hope these two topics are clear. Now from here we get a topic that is surplus. Now what is surplus? As in the case of Mr. A, 70k is surplus to him. In case of B, 10k is surplus, is extra funds that they have. Now let's study them deeply. What are the surplus funds in an economy? So surplus funds, what are surplus funds? That is extra funds that are in an economy. So what are the sources from where the economy get that surplus fund? Households, that is common people. If they have extra savings, they will invest it, they'll lend in an economy, they'll put it into economy. So that is going to be one of the source. Second is sometimes governments does this. Third is business enterprises also have sometimes excess funds, so they lend in economy, or you can say they provide loans. In any way they are putting that surplus in the economy. Now what does households do? As we took example of Mr. A and B, in that case we studied that Mr. B needs to borrow some money to finance his spending. So there are two kinds of finances that we are going to study now. So direct finance. What are direct finance? In this, the borrower directly borrows funds from the lenders. That is, there is no intermediary involved in it. In such cases, borrow directly in financial markets by selling securities. So in direct finance, no intermediary is involved. In indirect finance, the channelizing of funds is done through intermediaries. That is, there is an intermediary present between savers and borrowers, such as banks. We can take example of in bank HDFC. So commercial banks are involved in indirect finance. I hope direct finance and indirect finance are clear to you. Before ending the video, I mentioned a term here, security. So you should know that securities are assets for borrowers and debts for lenders, or you can say liabilities. If you have any doubt related to this topic, you can ask in the comment section. In next video we are going to study functions of financial sector. Thanks for watching.